Morning, welcome to ANZ News. It's Monday, the 14th of September. Welcome to the week. We're talking all-time high fragility in our markets at the moment, so handle with care. There's a ton of investor cash looking for a home in markets at a time when there are no clear, safe bets. The central bank's low interest rate policy and an increasing fear of holding cash in a bank has formed a predicament for those in this situation. Bank of America Merrill Lynch estimate that money market funds hold over $4.5 trillion in cash, private equity cash, and $1.5 trillion in US corporates, having raised $3 trillion of funds through investment grade and junk bond issuance of $1.8 trillion, bank loans $1 trillion, and equity raisings of $0.2 trillion. The other massive dynamic in markets right now is the behemoth, that is the passive ETF funds. These funds, the likes of Vanguard, etc., were born of the realization that managed funds were rarely outperforming the broader market index and charged expensive fees for that result. Thus, the birth of passive funds that didn't even try to guess and had low fees accordingly. This next graph that we're going to show you tells the story of outflows from active funds compared to the inflows to passive funds. There's massive growth there since around 2014. We've seen growth there. The problem is, as we've discussed recently, that this compounds the concentration problem within the US equities market, as these funds are often weighted accordingly to each equities index weight, perversely compounding that very issue. We've spoken before about how the 5 FAAMGs accounts for nearly a quarter of the S&P 500, and furthermore just the top 10 shares, again dominated by tech stocks, now account for nearly half of the value of the entire 500 companies comprising of this index. Check out this next graph here. 10 stocks in the S&P 500 accounted for more than 50% of August's 7.2% return. Of course, you've got your Apple, Microsoft, Amazon, Facebook in there. This is an eye-watering level of concentration, and not one since the dot-com bubble. This next chart here, top 5 stocks percentage of SPX market cap at all-time highs. 2020 also containing Microsoft, Apple, Amazon, Alphabet, and Facebook, with massive growth there. Something had to give, and last week we saw the tech-heavy NASDAQ see its fastest falls ever before easing. The danger of all that passive money in a concentrated position is, of course, momentum. Momentum has been awesome for those shares since the bottom of the February crash. It has been a self-fulfilling, self-reinforcing rally for the record books. However, last month we saw that culminate in a massively asymmetric positioning, leading to what Bank of America Merrill Lynch called an all-time high fragility, measured by the ratio of call-put options volume. Ears were well and truly pinned right back, as you can see from this next chart, and it usually plays out in one way. You can see previous spikes align with previous major corrections. This all the way back here for this next chart here to 2010, showing some highlights in February 2018 and how quickly we saw drops. February 2020 with that massive drop, and right at the moment in September 2020, yep, you can see what's probably going to come next. And so the multi-trillion-dollar question remains, where will all that cash go? If this correction continues, all that passive money will follow it down the hole. The smart money will be looking for a safe haven that was getting forgotten about as the tech stocks to the moon narrative ran to the peak. You can see in these next charts how the inflows of gold and silver ETFs have eased off just recently, as has the price. This is a healthy pause for something that was running too hot too quickly. For some it was time to take some profit, and for the other side it was time to buy the dip. Balance is key in these uncertain times, and taking some profit along the way is never a bad thing. Long-term holders are stepping back and looking at this epic macro setup, happy to hold and maybe add on the dips. Everyone is different and no one knows what will really happen. As with anything fragile, handle with care and use some financial bubble wrap. Just to finish up here, we'll show you these charts for weekly transparent gold holdings, weekly transparent silver holdings, onwards and upwards, as always with gold and silver during this period. Well, thanks for tuning in. Remember, you can always go to ainsleyBullion.com.au for all things gold and silver, Ainsley Wealth for all things cryptocurrency. If you haven't yet, check out our gold and silver backed cryptocurrency at goldsilverstandard.com. We'll catch you tomorrow.